Welcome back to Little Dog Investing, where we teach the little guy basic finance concepts to make them better value investors. Today, we're going to go over how to calculate the weighted average cost of capital, or the WACC, to be used as a discount rate when you make your DCF models. All right, so let's just go ahead and get into the numbers here. What we're going to do is I'm going to show you how to calculate a WACC, and then after I go through all the numbers, I will explain what it means for the discounted cash flow model. So we're going to need to find 10 things, not 10 things. What am I talking about? The 10-year treasury yield is one of the things we need to find, which is going to be our risk-free rate. The beta of Apple, our example is going to do Apple. We're going to find the WACC of Apple. We're going to talk about market premium a little bit, and then we're just going to find the market cap, total debt, and 1 minus the corporate tax rate. Okay, perfect. And I'll show you how to find everything. Most of this you can find through Google Finance. There's also an external tool that I use to find the debt, and I'll tell you about that once we get there. Okay, so we're just going to type in Google Finance, and then to find the 10-year treasury, we are going to consult the Chicago Board Options Exchange, index CBOE, TNX. That's how we find, and also that's a percentage, so we're going to divide this by 1,000. Okay, sweet. Now time to find the beta, which we can also use Google Finance for. We're just going to click on our ticker and then comma, quotes, beta. Awesome. Okay, now we're down to market premium. Market premium, I'll explain a little bit more after we just do the math, but essentially market premium is the added required return on top of the risk-free rate that an investor needs to invest in said company, Apple. So for me, I like to use 5.5%. You can do some research on what numbers you would like to put in, but this is a number that you can kind of play around with. If your required return on top of a 4.26 10-year treasury yield is 6%, go ahead, go for it. The higher the market premium, the lower the valuation will be when you run a discounted cash flow model. And the lower, vice versa, the lower the premium, the higher the valuation would be, which means you would accept a higher price when you're investing. Okay. And I'll explain a little bit more later. Okay. Market cap, we can also find using Google Finance. We're just going to do the same thing here. No spaces when you type in market cap. They don't like that, apparently. And this is going to be in dollars. Nice. It's a lot. Okay. And then for total debt, you can pull this from Yahoo Finance, but I have a service called Ticker Data that automatically shovels this into Google Sheets. So I'm going to go ahead and do that. It does cost money, but it's not much. It's like 24 bucks, or not 24 bucks. It's like 12 bucks a month, and it's so worth it, especially if you're doing a lot of valuations. And unfortunately, I can't pull 2025, so it actually might be helpful to go to Yahoo Finance and look at it. But the difference is not going to be enough to really make a difference in our WACC calculation. So go ahead and do that there. Also, just put this into money. Okay. And then the corporate tax rate, we're just going to use what it is in the United States. If you did this for a real living, you'd probably go through all the companies or all the countries that Apple operates in and calculate like a weighted corporate tax rate. We're just going to use 21%, so we'll just type in 0.79. Oops, I already have it in a percentage, so 79%. Perfect. Okay, and before we get into the cost of equity calculation, we're just going to go ahead and do equity weight, which can be found by taking the market cap divided by market cap plus debt. Perfect. And then the debt weight is just going to be 1 minus that. Or if you really wanted to check it out, you just take the total debt, divide by market cap plus total debt, and you get the same number. Okay, now that that's over. Okay, so for cost of equity, we are going to use the CAPM formula for all you finance majors out there. And that formula goes like this. You're going to take the risk-free rate, and you're going to add the beta, and you're going to multiply by the market premium. Awesome. Okay. And then to find the weighted cost of equity, we are going to take these two numbers and multiply them together. Oops. Perfect. And for the weighted cost of debt, we are going to take debt weight times 1 minus corporate tax rate times 10-year treasury yield. Awesome. And then I've already calculated up here, the WACC has already calculated itself. You just take the weighted cost of equity plus the weighted cost of debt, and then that gets your weighted average cost of capital. And as you can see, we automated everything, so that just changed. The market cap just changed. I don't know if you saw that, but you can type in any ticker, and it'll spit out the WACC automatically now. So you don't have to do this calculation every single time you look at a company. So yeah, Microsoft, let's look at Meta. All the companies, all the tech companies are going to have like relatively similar WACCs. I mean, Microsoft's an older one, so it had a little bit of a lower WACC. You're going to notice when you do this, the older companies are and the more predictable their cash flows are. Like a company like Campbell's Soup is going to have a pretty low weighted average cost of capital. Let's see. And then newer companies like, Palantir, let's see if it is going to have an enormous WACC. And I'll get into what this all means, but I just wanted to show you just for now how to calculate a weighted average cost of capital, which is going to be used as a discount rate when we run a discounted cash flow model. So let's get into what everything else means. It's in the name WACC. A weighted average cost of capital is a company's cost of financing. Therefore, you need a company's returns to its investors to outpace its cost of financing. And when I say returns for a discounted cash flow model, we are strictly talking about free cash flow growth, which is operating cash flows minus capital expenditures for said company. So right now I have Chewy thrown up on the screen, just a random company I was running a weighted average cost of capital for. And Chewy's WACC is pretty high. However, over the next 5 to 6 years, they're actually expected to grow their free cash flows by about 23% year over year. So just looking at that, it might be a good investment. Obviously, you have to run the DCF to see if it's a worthy investment. But just by looking at free cash flow growth versus WACC, you'd be able to tell this is a decent return for how much risk I'm taking. And like I said before, newer, more riskier companies such as Palantir are going to require higher growth to account for all of the risk that you're taking. And vice versa, more established companies with predictable cash flows, such as Campbell's Soup, will have lower WACCs, which means you're willing to accept a lower return because you're taking less risk. If you enjoyed this, subscribe to the page and follow our Instagram, Little Dog Investing, where we try to value a company every single day using a DCF, using a bunch of other valuation techniques, as well as drop a comment for what topic we should talk about in our next video. Thank you for watching Little Dog Investing.